This is Bloomberg.
I'm not going to do that thing where I give you a nice little neat narrative to explain the price action of the day, because in about 5 minutes it could all change. Futures up 0.7%. That's where we are right now on the S&P 500. On the Nasdaq, we're positive 0.9%, a bounce after closing in the bear market yesterday on the Nasdaq 100. There's the opening bow. Switch up the board and get to the commodity market. The crude market, which loves to make a fool out of pretty much everybody who tries to forecast it. 95.94 on WTI, 3.130 about a week ago. On Brent, sub 100 earlier this morning, approaching 140 a couple of Sundays back. In the bond market, your 10-year yield now coming back down by 5 basis points on the day to 2.08%. A week ago, trading in the 160s, twos, the 140s last week, and now in and around 180. Euro dollar 109.84, positive on that currency pair, 0.4%, just short of 110. At the opening bow, we advance about 0.8%. Top of the pile, utilities, real estate, information technology at the bottom. As you might expect, given where energy's trading this morning, crude lower, energy stocks lower by 1.3%. With your movers, here's Abby.
John, well, with this bullish start for stocks, let's start out with what is working, and that is most sectors, as you were just talking about. But relative to individual movers, technology very strong. NVIDIA, the chip overweight stock, is sharply higher, up 1.4%, as yields are lower, and really just a bounce back that extends to Tesla. They obviously have the EV part of the company that maybe does not fare as well from a psychological standpoint when oil is down, but the technology side doing just fine, up 2%. Delta Airlines soaring, up 9%. This, of course, as oil is in, as you were talking about, that translates right to the bottom line with not a lot of hedging there, plus jet fuel in. They're also at a JP Morgan conference, as are some of the other airline executives, talking about the fact that profitability is likely this year. Speaking of JP Morgan, yields are down, but the banks are extending the rally to a second day, John.
Abby, thank you very much. Tomorrow, the main event, the Federal Reserve. Your two-day meeting has already started. Here's Mike McKee with more. Morning, Mike.
Morning, John. Well, you just mentioned that commodities are making fools out of anybody who tries to forecast it. Imagine the Fed. The entire economy depends on you, and you got to forecast what's going to happen with commodities, particularly oil. Now, we know what's going to happen tomorrow. We're going to get a 25 basis point increase in the Fed funds rate, but they also have to update their economic forecasts and the dot plot. They're going to have to raise their forecast for inflation. The question is, how much? Then Jay Powell comes out and explains it all. Does he sound hawkish or not? Now, here's the big move of the day tomorrow, and that's the dot plot. You can see there the blue line is where the market thought rates would be on December 15th, the last time they put out the dot plot and the forecast. The line on the top, the white line there, is where the market thinks now those interest rates should be. How close does the Fed come to the market's belief? That's going to have a major impact on how people trade after 2 p.m. tomorrow. And there are a lot of questions for the Fed going forward. Risks, Russia war, obviously, and we don't know what's happening with oil because of that. COVID, signs it's coming back, and maybe there's some other surprise out there. Inflation, base effects coming into play here coming up in the next couple of months should push inflation down. If oil continues to fall, that should push inflation down. We'll have to watch that. And then, of course, the balance sheet reduction. When and how do they start cutting back on the balance sheet? A lot of questions for the Fed and a lot of things that are very hard to answer at this point.
They've got to deliver the forecast, Mike, whether they like it or not. Looking forward to your coverage tomorrow. Mike McKee there. The S&P 500 up 1%, 3 minutes into the session. The Nasdaq Composite up a little more than 1% as well. Jim Bianco of Bianco Research shot me a quick message just yesterday and said, remember the exchange with Chairman Powell and the Republican Senator Richard Shelby at a hearing just a number of weeks ago. Don't forget that, and let's take a listen again.
Is the leadership at the Fed under you and the Fed prepared to do what it takes to get inflation under control and protects price stability?
I hope history will record that the answer to your question is yes.
Kathy Jones, does Chairman Volcker turn up tomorrow?
Well, I think that is probably what's planned for tomorrow. But again, Powell has to really thread this needle. So he has to talk about how they're going to be tough on inflation. They're willing to do whatever it takes, and that certainly, that exchange stood out to me as well. On the other hand, you already have credit spreads starting to widen. Now we've got commodity prices having reversed. You've got the Ukraine war, which hadn't been anticipated, and you've got a very flat yield curve. So here we are, the 2s10s is down to under 30 basis points. That spread is very low. So how much can the Fed deliver in terms of, oh, we're willing to fight inflation with a bunch of rate hikes without just inverting the curve? So I think they're in a very tricky position. I'm hoping to hear something more on the balance sheet, although I think they'll probably punt that to the next meeting or the meeting after that.
James Camp, your expectations?
A tricky position to be sure of their own making, I would suggest. I think the key is going to be what the long end does in terms of reaction function. We have a war in Ukraine right now, and we only got down to 160 in the flight to quality trade, and we've already reversed that. I think the marginal buyer, the price indiscriminate buyer of treasuries, the Federal Reserve, exiting the market. I think the fact that we have essentially told Russia that their reserves are worthless is going to put some pressure on not only the dollar, but on the buyer of treasuries. And I think the Federal Reserve has to raise rates, one, to protect the dollar as reserve currency, and the second is to really be serious about the inflation outlook. So to me, the Fed has no good choices, again, of its own making. This is a political conversation. Make no mistake, Senator Shelby, President Biden. This is the Democrats in the White House have approval ratings that are struggling mightily because of this regressive tax. And so I think the long end goes higher. I think inflation pushes the long end higher. I think the marginal buyer is exiting, and I think the yield curve can steepen from here. And Kathy's quite right. It's too flat to tighten 4 or 5 times, but I don't think the current configuration stays. I think treasuries move higher from here.
James, if you think 10-year and 30-year yields go higher, aren't you essentially saying this Fed can engineer a soft landing? And how narrow is that runway? I'm trying to understand the range of probabilities around these outcomes. If your base case is higher yields, doesn't that mean you believe the Fed executes that soft landing?
Well, no, I think the Federal Reserve tightens credit conditions that are already, as noted, tightening. Spreads are widening. I think we get credit conditions into the tightening area, and that orchestrates a slowdown. I do think as rates push higher, at least technically, over the near term, that is going to be a very good buying opportunity for income investors, probably the best that they've had in a number of years. If we get to a 2.25, 2.5, and the back end of 2022 does look like a slowdown to us, perhaps not recession. But again, this is a tactical trade. We're seeing pressure on the long end. We're going to continue to see pressure on the long end. That does not mean we simply think we'll stay there and continue to go higher. Inflation is higher than 2%. In any scenario, it's going to be higher than 2%. So
yeah.
I just think that this is going to be a story of rising yields for the first half of the year, Fed front-loading the moves because of the political season, and the inflation data not getting better in large measure because of at the margin, the Ukraine incursion.
Mike Wilson, you're not waiting half a year. You're already there. In this note, we think long-dated bonds could offer a decent hedge for equity portfolios, which are now more at risk due to a growth slowdown. Why is that, Mike?
Well, I mean, it's for the reasons you kind of set up this question, which is I totally agree with your, talking about Senator Shelby's, questioning of Chair Powell and his response to that. I think it's quite clear that this chair is going to go the distance, okay, meaning they're going to fight inflation, and that's going to require, probably breaking the back on growth. So whether that's a recession or not, I really don't care. But I do think that particularly the back end, 20-year and 30-year tenor, now is starting to look relatively attractive if you're running a portfolio of stocks and bonds, and here's why. Our concern now is growth, okay? Our concern is not about the Fed. The Fed is overpriced at this point, just like it was underpriced 6 months ago. Now it's like a race to see who can have the most rate hikes in. It's kind of comical in that regard. But so we're priced, okay? We're priced for 8 hikes over the next year. If they get that done, congratulations. And I agree with the statement I read this week, the same thing. If they get 8 hikes done and back-end rates move out, that means they were successful in engineering the soft landing. I don't think it's going to be that smooth. That doesn't mean recession. It just means that growth expectations are going to come down. And so if you're worried about growth like I am, then the back end of the yield curve is offering you very cheap protection, like it usually does historically, okay? Because remember, in this sell-off of stocks, and by the way, we've been in a bear market for stocks now for 4 months, not a week. And that's been happening as rates have gone up, meaning bonds have not provided the shelter they typically provide, which means now they're actually probably a pretty good buy for that protection against a further growth slowdown. If you're not worried about growth, then you shouldn't be buying treasuries at the back end, okay? You should be buying stocks. But that's not our view. Our view is that we think growth is going to disappoint.
Mike, lift the lid on the index then. We've done a ton of work to punish tech names, big tech names. On the S&P, I believe year-end you're at 4,400. Let's get away from the index stuff just for a moment. Go into it sector by sector. And on the consumer, which I have to say, your outlier call as I go through your research with the team, has to be this consumer weakness. Where are you looking in the equity market that hasn't been punished that you think needs to be punished?
Yeah, well, we do still think that there's more risk on the downside for the consumer, particularly on the good side, but maybe even services too, we'll see, but definitely on the good side. We think technology is still overvalued in many pockets. But more importantly, John, we think that technology is inherently cyclical. Okay, this is the thing that I think a lot of investors don't agree with us on, which is that technology has a secular sort of bullish trend to it, but it's still inherently cyclical around that. And of course, pandemic did not allow that cyclical reset because there was a pull forward in demand. So I think there's a chance we have actually a recession, a mild recession in technology spending this year as a payback in demand. That needs to get priced, and that has not been priced yet. Industrial is also another area where you're seeing incredible supply chain challenges, and of course now with this invasion, that's going to make those worse. So those would be three areas I think where there's still probably significant downside, if the growth, kind of scare narrative plays out. If that doesn't play out and we're wrong about that, well then you have to worry about it.
So Mike, you put out a range of forecasts. Most banks do. There's a bear case, there's a base case, there's a bull case. Can you walk me through where you're leaning towards? What kind of scenario? You've gone through that, you've painted a picture. Now give me the numbers at the index level.
Sure. Yeah, I mean, we've written about this, and we are more skewed towards the bear case, and we were already the most bearish in our base case. Our base case was 4,400. Bear case was 3,900. Remember, that's a year-end target, okay? So we always expected to overshoot on the downside relative to our base. We were talking about 4,000, John, back in January as probably a place we would go to, and then we would have upside to the 4,400. But now 4,000 doesn't look that attractive if the year-end, price target is 39. We haven't officially moved to that yet, but we're leaning in that direction. So I would say where we would get interested now at the index level, okay, would be somewhere between 35 and 3,800 to give us the appropriate amount of upside given the risk that we're still assuming.
Mike Wilson, a clinic on the equity market, on the bond market. Kathy Jones and James Camp, the three of you, thank you very much. A day away from a Federal Reserve decision. Coming up, the US seeking to prevent China from coming to Russia's aid.
We have communicated very clearly to Beijing that we won't stand by if we will not allow any country to compensate Russia for its losses.
The Chinese government has some problems abroad and at home. We'll talk lockdowns next.
the National Security Advisor and our delegation raised directly and very clearly our concerns about the PRC's support to Russia in the wake of the invasion and the implications that any such support would have for the PRC's relationship not only with us, but for its relationships around the world.
Chinese assets, risk markets, equity markets are getting absolutely hammered at the moment, and there are three reasons for it. One's that, the relationship between Russia and China. The other is the regulatory hangover from last year, and now we're talking about lockdowns too. The team at China Renaissance Securities saying the following: the sell-off is overdone, but so's everything else. The market is crazy. There's no fundamentals anymore. This is what it sounds like, Damien Sasser, when you're on the wrong side of the trade. This might be worse than the 2008 financial crisis. I should not joke, but you know where I'm going with this. Damien, what's going on?
Yeah, you know, I mean, Jonathan, these moves in China, I mean, you almost have to look at it and think that the impact, the market impact, is actually worse than that of the crisis in Ukraine, right? I mean, look, let's just be clear. Tencent, Alibaba, and Meituan, three of the largest constituents within the Golden Dragon ADR index, within the Hong Kong China index, all are down roughly 75%. I'm talking in dollar terms. I'm talking in market cap. 75% of the market cap destroyed since February of 2021, Jonathan. It's quite unprecedented, even in China standards.
I wanted to talk about lockdowns with you, and then this headline just dropped from Dow Jones, the Wall Street Journal. Saudi is weighing using the yuan instead of the dollar for China oil sales. And take a look at what happened to dollar CNH intraday. Just look at this rollover following this headline.
Yeah.
Damien, walk me through what you think as I read that out. The Saudis are weighing using the yuan instead of using the dollar for China crude sales. That from Dow Jones.
That's amazing. I mean, look, you know, the reality is this, dollar yuan, and I was going to talk about it going in the other direction, because for the past 3 days, I mean, we've lost, well, I mean, roughly 1.1% in dollar yuan for a currency cross that's supposed to be managed by the PBOC, ultra stable. For it to go down 1.1% in that short a period of time is nothing short of spectacular. It's now down 40 bips on the year. Jonathan, as we know, the yuan, and many people have been talking about the China yuan as being the safe haven currency amidst the crisis, and it sure looked like it. But now with these equity market losses, I mean, all bets are off. And now, you're right, a little bit of support here on the back of the Saudi news.
Yeah.
But even that is kind of difficult to believe in the current environment. You know, my base case is the fact that China's going to want to toe the middle of the line here. They're going to want to do everything they can not to disrupt the relationship with Russia and the U.S. It's interesting to see how this will be perceived in Beijing.
Damien, stay there. Let's sit on this breaking news. We've got the perfect guest with us from London, Bloomberg's Javier Blas. Javier, we were going to talk about something different again, but let's just go right here. What do you make of that headline, Javier? Saudi, according to Dow Jones, weighing using the yuan instead of the dollar for China crude sales.
Well, it will be really unprecedented for Saudi Arabia to sell their oil in any currency other than the US dollar. They have been doing that since the 70s without interruption. So it's quite surprising, but we have seen news that Saudi Arabia wants the Chinese leadership to pay visit to the country. Saudi Arabia is also trying to sell another stake in Saudi Aramco. Potentially Chinese buyers could be interested. So it seems like a big pivot of the Saudi leadership towards China and moving against or away at least from the United States.
Javier, that divide between this administration and Saudi Arabia, do you think this line, this reporting, the sourcing for it has something to do with this? Are they speaking to China at the moment, or are they speaking to the administration, the White House?
I think that they are speaking to both. I think that they are certainly speaking to China, and the relationship between Saudi Arabia and China has improved significantly over the last few years. But I also think that they are sending a message to the Biden administration. If you don't like us, we don't need you. So make your mind. I think that Mohammed bin Salman sent that same message on the interview with the Atlantic magazine, saying that he didn't care anymore what President Biden thought about himself or the kingdom. And so, yeah, this is a message as much to Beijing as is to the White House. Saudi Arabia is saying we have other friends.
Javier, Brent's gone from close to 140 to 99. WTI's gone from around 130 to 95 in a week. Can you explain to me what's going on the screen this morning?
Well, it's difficult to explain when you look at the physical market and you see how tight the physical market is. But two very bearish factors right now. One is the lockdowns in China that we were discussing, and then the potential good news on a potential nuclear deal between the United States, Russia, and other countries, and Iran. So that could bring more extra supply from Iran and also reduce the demand from China. But one thing that we are seeing is as virtually everyone in the oil market is taking a step back and stop trading. If you look at the open interest, the amount of outstanding contracts is at a 6.5-year low. If you look at the bid-ask spread has widened and at times is at 6-7 cents of a dollar. I mean, this is the world's most liquid oil contracts, WTI and Brent. It should trade on a bid-ask spread of 1 or 2 cents, no more than that. We are seeing at times this morning the bid-ask spread as wide as 7 cents. That is unusual, and it really is an indication of the very little liquidity that there is out there in the market.
And Damien, that's the commodity market. I wanted to finish on one final question with you as we shift forward to tomorrow in 30 seconds, because you and I will have this conversation tomorrow anyway.
Yeah.
Those two interest payments on those two Russian bonds, you think they're going to be missed?
Well, I mean, look, yes, I do. I absolutely do. But, we're not going to know about it tomorrow, and we may not even know about it the next day or the day after that. But I do believe that there is a willingness on the part of the U.S. not to accept that payment. More importantly, Russia is kind of reluctant to make the payment, right? So I don't believe they're going to be, look, and even if they don't default tomorrow, heaven forbid they find a way to deliver dollars offshore to creditors, and this all we're seeing with Clearstream and Euroclear and all the piping and the plumbing that goes hand in hand with making those payments. Even if they try and make their best effort, I'm still not convinced that it's not going to lead to a default further down the road. Remember, value at risk shocks occur in both directions, and they occur in stages, Jonathan. They begin with price, they then go to vol, and then they go to the real economy. I think the economy is starting to look through the inflationary shock, looking to the growth slowdown at the end of the year, and I think that's where we lie.
Damien, fantastic as always, buddy. Gents, thank you. Damien Sasser, Javier Blas on this crude market, China, and everything else, including Russia tomorrow. Let's get you some sector price action. We can do that with Kriti Gupta. Morning, Kriti.
Yeah, good morning, John. You are seeing a fairly broad rally in the market. Consumer discretionary is your leader. Your one sector in the red is going to be energy, of course, following those energy prices lower you were just discussing with Javier Blas. Let's round out that conversation, though, and talk about what it means for the airline stocks, because that's where you're seeing really a lot of action. Your biggest movers this morning are going to be your airlines, United, Delta. This, of course, comes off of news that Delta sees its first quarter revenue about 78% recovered versus 2019 levels. That's relative to the 72 to 76% range that you are seeing earlier. And last of all, remember, a lot of these companies aren't hedged against oil prices. When you see oil tank, that's good for the airlines.
Kriti Gupta, thank you. Coming up, the market moving events in your trading diary. That's next from New York. This is Bloomberg. 25, let's call it 26 minutes into the session. We advanced by 0.6% on the S&P. On the Nasdaq, bouncing back by 0.75%, closing on the Nasdaq 100 in a bear market yesterday. The winner of the year, the loser of the session, energy equities. Why? Well, here's the why. Crude, Brent, down 6%. WTI, down 7 from 130 and back down to 95, just like that. Very quickly. That's the price action. Here's the trading diary at the top of the hour. NATO chief Jens Stoltenberg holding a news conference. European officials meeting to discuss Russia, 10:30 Eastern. Russia's coupon payments on $2 bonds coming tomorrow. We will hear from the president of Ukraine addressing Congress as well. And a big week for central banks with the Federal Reserve kicking things off. From New York City, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on this Tuesday, March 15th. Here are the top market stories we are following for you at this hour. Crude off a cliff. Oil plunges back below $100 a barrel, sinking 20% in just the last 5 days. The drop in prices easing inflation concerns along with some cooler than expected U.S. PPI data. Bad memories. It feels almost like 2008 again as the sell-off in Chinese stocks deepens. ADRs of Chinese tech giants sink anew and the U.S. trade as concerns mount about regulatory pressure and ties to Russia. And the dash to Kyiv. The prime ministers of Poland, the Czech Republic, and Slovenia head to the Ukrainian capital to meet with President Zelensky. This as the UK joins its European allies in rationing up sanctions on Russia. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, the story of the day, oil front and center.
It is absolutely amazing. A combination of factors coming together here. It looks like basically the concerns about a Chinese slowdown is outweighing the concerns about what is happening with supply as a result of the Ukrainian war. You've also got the possibility of an Iran deal thrown into the mix as well. It's a heady combination, as you said, Kaylee. Massive move down in prices. I was listening to Javier Blas just talking a moment ago to John, talking about this idea that a lot of people have stepped back from this market. The bid-ask absolutely massive this morning. You can understand why. How do you trade a market like this? How do you, if you're a consumer of crude, how do you position for this? Abigail was talking just a moment ago about what's happening with the U.S. airlines. They don't hedge. The price swings in terms of their costs must be absolutely eye-watering. How do you run a business in that kind of situation?
Yeah, I think that is exactly the question, which brings us, Guy, of course, to kind of our question of the day. And when you see this kind of volatility in oil, when crude is crashing, is that actually good news or is it bad news?
Absolutely. Well, let's kick that around. Actually, before we do that, I just want to flag as well something else that has just happened. Ukraine raising another $185 million in a war bond. We'll wait and see ultimately whether or not this gets repaid. Clearly, the bigger question of the week right now is whether or not Russia is going to be able to actually make its payments on its dollar-denominated debt, or whether or not we're going to see a default this week. Anyway, we'll park that for the moment. We will come back to it. Let's talk about our question of the day. Is this drop in crude good news or bad news? Bloomberg's international economics and policy correspondent Mike McKee joins us, and our markets reporter Abigail Doolittle is back. Mike, what do you think? Is this good news or bad news? Because this is a demand story on one side and a supply story on the other.
Well, on balance, I think you'd have to say it's good news. You look at where we are in terms of crude oil right now, and it is almost back to where we were at the beginning of February before, at the end of February before the invasion. And so it suggests that maybe some of the inflation pressure the Fed has to deal with is going to come off. You were talking earlier about how do you trade this market? Well, how do you forecast it if you're the Fed and what it's going to do for the overall economy? It's really, really difficult. And so I think for the Fed, it's reasonably good news to the extent it shows some demand destruction. And the OPEC report just came out moments ago saying they expect demand to fall off around the world because of the Russian war. That does part of the Fed's job for it. So I think the only thing perhaps harder than forecasting for the Fed what's going to happen is the market's forecasting what the Fed's going to do.
Well, and obviously when it comes to forecasting, Abigail, you take a look at the technicals to give us some sense of where things are going to go. And there was a day last week when oil had turned around and I said, Abigail, what happened? And you're like, I don't know. The chart's not looking good. I mean, what are you seeing?
Well, you know, it's really a case of what goes up must come down. We had panic buying in oil, and from a fundamental standpoint, there was good reason for it, only because there's such tight supply and demand. But when you have such a parabolic move up, typically it cannot sustain itself. We've seen it time after time with various commodities, gold, silver, through the years, and now with oil, and simply oil's coming back down. Now, it's interesting, oil's now close to its 50-day moving average. It's actually technically confirmed for the 200-day moving average. That's $77 a barrel. That's a huge, huge reversal. As for the markets, I would agree with Mike. It has to be a positive, or it's likely a positive. Inflation coming out of this story, some pressure off of stocks. But it's so interesting that as we have oil coming down, we have rates going higher, so that seesaw between rates and oil.
Okay, Mike, let's just explore this a little bit. The reason I asked the question, the reason we were kicking this around earlier, is the reason why oil's coming down is because China's having a demand shock, because it's shutting its economy down. And that's going to have ripple effects in terms of trade. That's going to have ripple effects in terms of the supply chain. This was the inflationary narrative that we were talking about only a few weeks ago before the Ukrainian conflict started. China's economy is slowing down. What I'm wondering is do we now need to think more about the recession aspect of what is happening here rather than what is happening with the inflationary aspect? China's economy is slowing down pretty rapidly right now as a result of these lockdowns. Is that something that we should worry about as investors? You've seen what's happened with stocks overnight.
Think but don't worry, because we don't have enough information to know how long this is going to last in China. Now, obviously, there are supply chain implications. Shenzhen, a big transit point for electronic goods. We could see some more interruptions. In the meantime, without those ships leaving China coming to the United States, the U.S. ports are going to be able to clear some of their backlog. So really what you're looking at the moment is volatility. Everybody's been talking about stagflation. If oil prices come down, maybe we don't get the inflation part of that, but we get the stag because we have shortages of goods. Although the latest numbers in the New York Fed's Empire survey showed inventories rising. If that's the case in other Fed districts around the country, we may be able to escape the worst.
Well, that's some of the economic data we got this morning, Mike. But on the other hand, we also got PPI. Speaking of inflation, yes, you had a 10 handle on the headline number. When you back out food and energy, it was actually lower than expected. Same with the month-on-month number. I mean, how do you think the Fed looks at that today and tomorrow?
Well, they're going to look at it as one data point, but it's a good trend. I mean, you look at what happened with the core rate for PPI, leave out energy and food. It was up just 0.2 after an 0.8 rise the month before. And so if that trend were to continue, we can isolate energy and food from the inflation issue, and the Fed is going to focus on the core, and that might mean they have to do less. Again, it's just 1 month, but it's the first hopeful sign we've seen in some time.
Abigail, we saw the NASDAQ down last night aggressively into a bear market, but that pales into insignificance compared with some of the moves that we're seeing in some of these Chinese tech stocks. Again, what are the charts telling you? What are you seeing in some of these numbers? Alibaba, you look at how aggressive that move has been, and it's not just over the last few days, it's been months in the making.
Yeah, it's been more than a year. I mean, that stock peaked February of last year, and that was really what kicked off the big selling in the China tech shares, the regulatory pressures out of Beijing. Those stocks basically down 75%. And the question all along is, will it at some point drag on the U.S. tech stocks? As you mentioned, the NASDAQ 100 yesterday closing in a bear market for the first time since March of 2020, that deep selling pressure. So perhaps some of the answer is that, yes, there is a drag. You know, relative to the recession question, the growth slowing question that you were talking to Mike about, and Kelly was talking to Mike about, you know, in terms of China, that is certainly a concern. But that probably could be a concern here, too, at some point. When we bring the yield curve back into the conversation, we've talked about this before, the idea that the yield curve seems likely to invert. If and when that does happen, typically a recession, as you know, follows 9 to 12 to 18 months after. So in terms of this bear market that we had in the close for the NASDAQ 100, I would argue that what we're looking at here is probably something akin to a rolling bear market, maybe something more similar to 2000 when it took 2 or 3 years for everything to work through. In that context, there can be some spectacular bear market rallies. Whether or not we're looking at that right now, up 0.7%, not a huge gain, but the Fed really could change the conversation here based on what they say tomorrow.
All right, Bloomberg's Abigail Doolittle as well as Michael McKee, thank you both very much. Now, as it relates to the geopolitics happening in the world, I do want to bring you some headlines out of Jens Stoltenberg, who, of course, is the NATO Secretary General. He is speaking at a press conference from NATO in Brussels, saying Russia could stage a false flag operation. He also says he's worried that Russia could use chemical weapons. Of course, we saw this addressed by President Biden last week, who warned of severe consequences should that happen. Unclear what exactly those consequences would be. But again, the NATO Secretary General Jens Stoltenberg talking about a potential use of chemical weapons by Russia, as well as a potential false flag operation. So coming up, we'll talk more about the war ongoing in Ukraine and what the real risk to markets is. Our next guest says it's time to focus on fundamentals. We'll talk to Caterina Simonetti of Morgan Stanley Private Wealth Management next. This is Bloomberg.
Highest since 1982.
War.
This is the central banking nightmare because there is no good answer.
Everyone is eyeing the Fed's next move.
We are getting whipsawed.
I think they have to move.
Trust Bloomberg for the fastest coverage and exclusive analysis.
The market is pricing 50 basis points. The Fed should walk through that door.
Look for massive adjustments.
It's going to be a very delicate task.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. The fastest way to stay one step ahead.
Oil is crashing. WTI is now trading at $94 a barrel when just a week ago today, it got a taste of $130. So let's talk about this crude crash. Is it good news or is it bad news? That is our question of the day, and we pose it now to Caterina Simonetti, Senior Vice President and Private Wealth Advisor for Morgan Stanley Private Wealth Management. So, Caterina, you look at the move in oil, which to some extent arguably is being driven by growth concerns out of China. Can you take this as good news or is it bad news?
Kaylee, it's just a challenging time for the market, period. And investors are concerned about the growth, concerned about inflation, concerned about the Fed action. And in this context, the lower oil prices will be a good thing. But would we have to really question if this move today, is it a permanent move? Is it something that, if anything can be permanent in this market, of course, is something that can stay here for some time, or is this just the move of the day? Because there is so much pressure because of the Russian-Ukraine war on the oil prices to go higher, major concerns about supply, major concerns about what it's going to do to the future earnings, especially as we've had earnings concerned going into this year period before this variable was introduced. So I think lower oil prices would be a good thing. I just question if this is something that we can count on.
Caterina, it's Guy. How do investors, not traders, how do investors deal with this kind of volatility? The crystal ball is incredibly cloudy at the moment. As you say, we've got a Ukrainian war to deal with. We've got the Chinese slowdown potentially exacerbated by what is happening with the COVID lockdowns to think about. You've got the Fed tightening policy. You've got inflation. Just in terms of what are you telling your investors right now about what they should be doing with their money? What's your degree of certainty? What's your degree of conviction right now about what the right call is to do with fresh money or invested money right now?
Guy, it will be safe to say that the crystal ball has been removed. And this is just such a difficult, unprecedented environment for investors. But one thing we know for sure is that investment decisions cannot be driven by fear. They cannot be driven by emotion. They have to be driven by strategy and opportunity. And even though going into this year, we were concerned to begin with about multiplicity of risks, and this introduced this this totally different variable, what we tell investors is that 100% they have to stay invested. They have to improve the quality of their portfolios if they have not already done so. They have to look at geopolitical risk, not as the risk that is going to be staying here forever, but at the risk that is affecting every area of this market and therefore presents the opportunity. And last but not least, we have to pay very close to inflation, which is at the 40, 30-year high. We've never been in the situation where interest rates are low, inflation is high.
Caterina, I hear what you're saying, but year to date, equities are down aggressively and bonds are down aggressively. That is the bulk of most people's portfolio. Why are you not saying to investors, maybe you should think about some cash here? The big moving parts of most people's portfolios are underperforming significantly right now. So why are we not in a position where we think cash is going to be the asset for the year and cash is going to actually outperform?
It's an excellent point, and especially in times like this when investors are looking at their portfolio and its significant losses that they have not seen for last couple of years. And naturally, our inclination is to go to cash because cash seems like such a safe, comfortable asset class. What we cannot forget is cash is not an earning asset class. We make absolutely nothing on cash at the moment. And with inflation at 7.9%, our cash deposits are going to be losing our purchasing value at 7.9% per year. Hopefully there's some type of normalization is going to happen, but investors must put themselves first and must look at the real yield opportunities within their portfolios, both in bonds, both in stocks. Real yields matter, and the income that portfolio generate matter now more than ever. So we have to take a very close look at stocks and bonds. And I hate to, I actually can't believe I'm saying this, but we are starting to like bonds again. I mean, maybe not yet, but as interest rates go up, there's going to be, multiple opportunities in the bond market as well as in the stock market.
So Katerina, are you saying that even though a 60-40 portfolio is having its worst start to a year since 2008, that is still a formula that works?
Absolutely. I'm looking at it as the long run. And I know that every investment manager out there says this, and investors are a little bit tired of hearing the term, but we truly need to look at this as a transitory type of situation. I've got to believe that this terrible conflicts in Ukraine that is affecting all of us so much is not going to last forever, even though the consequences of it, even if it is all resolved shortly, is something that we're going to be feeling and dealing with for years. So we have to be strategic. We have to be opportunistic. We have to take a look at our 60-40 portfolio and look at it from a perspective that it has done very well for us and for many years, and it's going to continue to do so. And yes, the total value of the portfolio might be down, but the income producing power of the portfolio, the real yield that the portfolio generates, is still there. And it is so important for investors at the moment because of this high inflationary environment that we're dealing with, and the fact that, Fed is going to be tightening. There are still risks. We, are concerned about the earnings. We're concerned about the growth, but we're not looking at this as a recessionary environment. We're not seeing recession on the horizon yet. And we're hoping that with a quick resolution of this conflict towards the second half of the year, there might be some type of market normalization. So my advice to investors with 60-40 portfolio is absolutely stay put, but pay close attention, know what you own, look at valuations, look at quality, stay with defensive sectors.
Sounds like an active market to me. Katerina, thank you very much indeed. Katerina Simonetti, Senior Vice President and Private Wealth Advisor for Morgan Stanley Private Wealth. What are we going to do next? The Prime Ministers of Poland, the Czech Republic and Slovenia, they're getting on a train and heading to Kiev to show their support for President Zelensky. We've also got a briefing taking place right now. The NATO Secretary General Jens Stoltenberg is holding that news conference. There is the live shot coming from NATO headquarters in Brussels. We're going to bring this all together next, give you an update on what you need to know. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. United Airlines has become the first major U.S. carrier to cut back on planned flying because of soaring fuel prices. United's first quarter capacity will be 19% below 2019 levels, a bigger cut than originally expected. Costs will be 18% higher than a year ago. In the UK, unemployment has dropped below its pre-pandemic level for the first time. The jobless rate fell to 3.9% in the 3 months through January, and employers added 275,000 jobs in February, more than double the number expected. And that is your latest Business Flash. Kaylee?
All right, Ritika, thank you. Well, it's an unexpected show of support for Ukraine today. The prime ministers of Poland, the Czech Republic, and Slovenia traveled to Kyiv to meet with President Zelensky. They plan to announce another package of support for Ukraine. Joining us now, Bloomberg's Anne-Marie Hordern in Washington. Anne-Marie, just how significant is it to see this entourage of Eastern European leaders heading towards a Ukrainian capital that is currently besieged?
It is incredibly unlikely that you would see this, but it just goes to show how these leaders want to come out and show their support, not just in messaging or sanctions against Russia, but physically going to meet the Ukrainian President Volodymyr Zelensky in Kiev, which right now you say, Kaylee, is besieged. There's a war in this country, and you see these three leaders from the Czech Republic, Slovenia, and Poland making a journey into a war-torn country to meet with that president. I think this speaks volumes.
I think it speaks volumes about how concerned they are about what is happening here and the possible escalation. Anne-Marie, you've been asking about this, and Jens Stoltenberg, the NATO Secretary General, who we can see on the other side of the screen, briefing about it, talking about NATO's fear that Russia could use chemical weapons. You've been asking the White House about the possible consequences were that to happen and the repercussions of it. What are you getting back from the White House? How clear a plan is there were that red line to be crossed?
Well, I think they've made it pretty explicitly clear that they think President Vladimir Putin, talking about the fact that the U.S. has these biolabs in Ukraine, is using this as a disinformation campaign and setting up this stage to actually use chemical weapons in Ukraine. So you've heard a number of officials talk about the fact that they are concerned and worried about this. And then on Sunday, Jake Sullivan, the president's national security advisor, told the Sunday show that there would be, quote, severe consequences on Russia if they were to do this. We also should note that in our reporting from Alberto Nardelli and Jennifer Jacobs, that Jake Sullivan is actually trying to set up a phone call with his Russian counterpart. He's the secretary of Russia's national security. His name is Nikolai Pestruv, and they would want to set up this call for the explicit reason to tell Russia not to go ahead and do not use chemical weapons in Ukraine. So obviously this is something that is incredibly worrisome here at the White House, as well as for NATO members.
Well, and you speak of who Jake Sullivan is talking to. We also know that he's met with some of his counterparts in China. Anne-Marie, where does the administration come down on how confident they are about whether or not China is going to intervene in some way in this crisis?
Well, the Financial Times is reporting that, and then our reporting as well, was that there's U.S. cables to Europe saying that Russia had already asked for these military drones in February, and there is potential concern that they would potentially abide by this. Remember, it was in February when Xi Jinping and Vladimir Putin stood next to each other and they talked about a relationship that has no limits. President Putin is incredibly more isolated, and he's looking east from his friend in Beijing to try to help him in this moment. Jake Sullivan had this 6-7 hour meeting with his counterpart. We don't know a lot about exactly the details of this meeting, but the United States said that it was substantial. The Chinese pretty much agreed with the same kind of tone. But we should also note this morning, the Foreign Affairs Minister of China talked about sanctions and how they don't want to get in the crosshairs of sanctions. So China right now walking a very difficult line.
Anne-Marie Hordern joining us from the White House. Thank you very much indeed. Coming up next, the latest report on inflation at the wholesale level is out, and it sets the stage, of course, for the Fed to raise interest rates this week. We're going to talk to a former Fed economist, Claudia Sahm. That conversation next. This is Bloomberg.